Welcome students. Once again we will start with chapter 6 again, cash flow statement, continuing from the last class where we have ended. Now we will start with investment sale purchase and asset account at net value and the questions to follow. So let's start. Investment sale or purchase can also be dealt in a similar way by making an account, as we will see in the questions to follow. But profit or loss will again be adjusted in operating activity. If there is a profit on sale, it will be deducted from operating activity, and if there is a loss on sale, it will be added back in operating activity, and the amount received from sale of investment will be added in investing activity, and the amount paid for investment will be also deducted in investing activity. Now, if fixed asset is made at net value, then we will also show depreciation on the credit side, because we can reach the net figures only after depreciation. The format will look like as follows. See the format. Fixed asset at net value. We start with opening balance on the debit side and the closing balance on the credit side. Now, if some asset is sold, we will show it on the credit side by bank sale. This will be added in investing activity, and if there is a loss, it will be also shown on the credit side by profit and loss account loss, added in operating activity. And one very important point, we will also show depreciation for the year on the credit side, because it is a net method and it will be added in operating activity. And if there is any balancing figure on the debit side, it will come as two bank purchase, that is taken in investing activity as a deduction, because we have purchased an asset and the money is flowing out. So you can see the difference in cost and net value. In the cost method, we were not shown depreciation on the credit side, but in the net method, we are showing depreciation on the credit side. So this is the basic difference. Now let us examine few questions on these above important adjustments. To start with the fixed asset at cost. Let us see the question. Suppose we are given plant and machinery at cost 2 lakh and 3,50,000 in two different years, that is 2010 2 lakh and 2011 3,50,000. Accumulated depreciation in 2010 70,000 and in 2011 95,000. Another adjustment is given. During the year, a plant costing 70,000 with accumulated depreciation 25,000 is sold for 60,000. Make account to show all the adjustment and their effect. Let's start with the solution. Plant and machinery at cost. We start with opening balance on the debit side 2 lakh and the closing balance on the credit side 3,50,000. Now, on the credit side, we will write by plant sold 70,000. Please remember, we have to show cost, and this will be transferred to plant sold account debit side, that is to plant 70,000. Similarly, accumulated depreciation account starts with an opening balance of 70,000 on the credit side and closing balance 95,000 on the debit side. Now, 25,000 accumulated depreciation is on sold item. So it will be transferred from accumulated depreciation debit side to the credit side of plant sold account by the name to plant sold, and in plant sold account by accumulated depreciation. Now, in plant sold account, we will write by bank, that is the sale part 60,000. So now we are getting a profit of 15,000, which will be deducted from operating activity, and that sale part will be shown in the investing activity as an addition. Similarly, in the accumulated depreciation account, we will get a balancing figure on the credit side, and this is depreciation for the year 50,000, which will be transferred to operating activity and added there as non-cash item. And in plant and machinery cost account, we are getting a balancing figure on the debit side to bank 2,20,000, which is purchase of asset, and it will be deducted from investing activity. Now let's examine a question on the net method also. Read the question. Building net value 10 lakh in 2009, 7 lakh in 2010. During the year, a building with book value 8 lakh sold for 9 lakh, and depreciation during the year is 2 lakh. When we will make the building account at net value, we will start with the opening balance 10 lakh on the debit side and closing balance on the credit side 7 lakh. Now, what amount has been sold? It is 9 lakh. So, we will write by cash 9 lakh on the credit side and by depreciation 2 lakh on the credit side. Now, please remember 8 lakh rupees building has been sold for 9 lakh. So, there is a profit of 1 lakh, which will be shown on the debit side of building under the head to profit and loss profit, and you will get a balancing figure to bank 7 lakh as purchase. Now, what will we do with all these items? Rupees 1 lakh profit will be deducted from operating activity. 9 lakh sale will be shown as addition to the investing activity. 7 lakh purchase will be shown as deduction from investing activity, whereas depreciation of 2 lakh will be added in operating activity. Now, let us start with a question on provision for tax. This is a very important adjustment and generally come in the exams. Let's start with the question. Provision for taxation, opening figure 50,000 for 2012 and 70,000 for 2013. During the year, 60,000 tax provision was made. Let's start with the solution part. Make an account provision for tax. On the credit side, start with the opening balance 50,000 and on the debit side, write the closing balance 70,000. Now, this provision for tax 60,000 will be shown on the credit side as by P&L account 60,000, which will be added in operating activity again, being a non-cash item. And on the debit side, you will get to bank as a balancing figure 40,000, that is tax paid, which will again be deducted from operating activity in the end. Now, let's see some other important points and observation before going to the full and final question. Point number 1. Income tax paid is shown as deduction from operating activity, but net of refund, because refund is what you are getting from income tax and income tax paid is what you are paying to them. So, both should be adjusted and then it should be shown as a deduction or as a receipt. Next point, dividend paid is always a part of financing activity, maybe financing company, maybe non-financing company, but dividend received is an operating income for financing company, whereas it is an investing income for all other companies, right? Next point, if security premium reserve is utilized for writing off discount on issue, underwriting commission, preliminary expenses, etc., no adjustment is required because premium is reduced and preliminary expenses is also reduced. You know, as per revised schedule 6, now these items are not shown in the account. I'll come to it after some time. According to the revised schedule 6, miscellaneous expenses, discount on issue, preliminary expenses are either written off from security premium account or debited to statement of P&L account. Now, if they are not appearing in the balance sheet, that means you don't have to do anything. So, nothing is required for their treatment. But if they are appearing maybe in the old format questions or in the new format as a detail, then they should be treated as follows. If they are decreasing, age should be added in operating activity, that is the amount written off. And if underwriting commission is increasing, then it is deducted from financing activity because you have paid that commission for your issue of share. Similarly, if discount on issue of share is also increasing, it means we have issued shares on discount, which shall be deducted from the proceeds of issue of share, and net amount should be shown in the financing activity. That is, if the shares are of rupees 100 and 10 rupees has been allowed as discount, so we will take 90 rupees in the financing activity. Next, point number 5 is an observation for security premium reserve account. Any increase in security premium reserve means we have issued our shares at premium, so it is added and shown in the financing activity. And any decrease means it has been utilized for writing off miscellaneous expenses, discount on issue of share, etc. And as I told you, nothing to be done then. Next point, dividend received by a financing company is an operating activity, whereas it will be an investing activity for all other companies. Now, let us examine a full-fledged question on cash flow with adjustments in detail. So, let us start with the question. Equity and liabilities, first point, shareholder funds, share capital, that is 10 lakh in 2012 and 12 lakh in 2013. That means we have issued the shares of 2 lakh rupees. Next, reserve and surplus. Statement of P&L is given 20,000 negative in 2012 and 1,24,000 as positive in 2013. That means we must have earned so much money which has written off 20,000 and still there is 1,24,000. That means 1,44,000 is the amount of profit which we have made this year. Okay, the next point is security premium reserve after writing off miscellaneous expenditure is 50,000 in 2013 and zero balance in 2012, and miscellaneous expenditure is shown as a negative item 20,000 in 2012, which means that actually security premium was 70,000. After writing off 20,000, it is now 50,000. Now, what you have to do is you have to show 70,000 as security premium in financing activity and nothing to be done for miscellaneous expenses, right? Because it has already been adjusted. Now, non-current liability, long-term borrowing, which is comprising of two parts, 10% debenture 2 lakh to 3 lakh and mortgage loan 4 lakh to 3 lakh. If you add them, it is becoming 6 lakh and 6 lakh, which means you can say there is no change. But please remember, debentures have increased and loan has decreased. So, you must tell both these items in financing activity, as it can be of interest for investors and other people. Next point, current liability. It comprises of trade payable and provision for doubtful debt, which are increasing from 20 to 30 and 10 to 15. I think you know these will be adjusted in operating activity for working capital change. On the asset side, we have non-current asset, fixed asset at cost 15 lakh to 19 lakh and less accumulated depreciation 20,000 to 70,000, making it a net of 14 lakh 80 and 18 lakh 30,000. Next point is investment non-current, 50,000 to 70,000, that means 20,000 we have purchased, it will be shown as a deduction in investing activity. And current asset, inventory, trade receivable, cash and cash equivalent, I hope you know inventory and trade receivable will be adjusted in operating activity and cash and cash equivalent will be adjusted in the end. Let's examine two adjustments also. Dividend paid 50,000, it will be added in operating activity and shown as a deduction in financing if we have not taken net profit before tax, right? And the next point is fixed asset at cost 2 lakh with accumulated depreciation 20,000 sold for 2,50,000. We will make an account at cost and show the profit and loss accordingly in the operating activity as well as 2,50,000 as an addition in investing activity. So students, that's how we do cash flow statement in detail. In our next class, we will be starting with a very important topic introduced this year, that is value based questions on partnership, company accounts and all. And till then, goodbye and thank you very much.